One of the best ways to secure your financial future is to invest, making sure that you have a diverse portfolio and appropriate long-term investments. In the wake of the current COVID-19 pandemic situation, the global market is almost at a collapse, with unemployment at all-time highs and the fear of recession looming over everyone. Thus, it is important to focus on investing in the right avenue for guaranteed returns, which will ensure a bright financial future. So here are 8 great investments to make in 2020. In the world of stock investing, growth stocks are the Ferraris. They promise high growth and along with it, high investment returns. Growth stocks are often tech companies, but they don't have to be. They generally plow all their profits back into the business, so they rarely pay out a dividend, at least not until their growth slows. Growth stocks can be risky because they lose value very quickly in a bearish market. However, growth stocks have been some of the best performers over time. If you are going to buy individual growth stocks, analyze the company carefully. Due to the volatility in growth stocks, you will have to commit to holding the stocks for at least 3 to 5 years. Growth stocks are among the riskier segments of the market because investors are willing to pay a lot for them. So when tough times arrive, these stocks can plummet. That said, the world's biggest companies, the Facebooks, the Alphabets, the Amazons, have been high growth companies, so the reward is potentially limitless if you can find the right company. A stock fund is a fund that invests in stocks, also called equity securities. A stock fund is an excellent choice for an investor who wants to be more aggressive but does not have the time or desire to make investing a full-time hobby. Moreover, by buying a stock fund, you will get the weighted average return of all the companies in the fund, so the fund will generally be less volatile than if you had just held a few stocks. A stock fund is less risky than buying individual positions and less work too. But it can still move quite a bit in any given year, perhaps losing as much as 30% or even gaining 30% in some of its more extreme years. That said, a stock fund is going to be less work to own and follow than individual stocks, but because you own more companies and not all of them are going to excel in any given year, your return should be more stable. With a stock fund, you will also have plenty of potential upside. Broadly diversified funds like S&P 500 Index Fund or a Nasdaq 100 Index funds are recommended. A bond fund, either as a mutual fund or ETF, contains numerous bonds, often from a variety of issuers. When a company or government issues a bond, it agrees to pay the bond's owner a set amount of interest annually. At the end of the bond's term, the issuer repays the principal amount of the bond and the bond is redeemed. A bond can be one of the safer investments, and bonds become even safer as a part of a fund. Because a fund might own hundreds of bond types across many different issuers, it diversifies its holdings and lessens the impact on the portfolio of any one bond defaulting. While bond funds can fluctuate, a bond fund will remain relatively stable, though it may move in response to movements in the prevailing interest rate. Bonds are considered relatively safe relative to stocks, but the return on a bond or bond fund is typically much less than it would be on a stock fund, almost 4 to 5% annually. Where growth stocks are the Ferraris of the stock world, dividend stocks are sedans. They can achieve solid returns, but they're unlikely to speed higher as fast as growth stocks. A dividend stock is simply one that pays a dividend, a regular cash payout. Many stocks offer a dividend, but they are more typically found among older, more mature companies that have a lesser need for that cash. The big appeal of a dividend stock is the payout, and some of the top companies pay 2 to 3% annually, sometimes more. However, importantly, they can raise their payouts 8 or 10% per year for long periods of time, so you will get a pay raise typically each year. The returns here can be high, but will not usually be as great as with growth stocks. Dividend stocks tend to be less volatile than growth stocks. A dividend-paying company is usually more mature and established than a growth company, and so it is generally considered safer. That said, if a dividend-paying company does not earn enough to pay its dividend, it will cut the payout and its stock may plummet as a result. Real estate is the prototypical long-term investment. Real estate can be an attractive investment because you can borrow the bank's money for most of the investment and then pay it back over time. That is especially popular as interest rates are very low. Anytime you are borrowing significant amounts of money, you are putting extra stress on an investment turning out well. But even if you buy real estate with all cash, you will have a lot of money tied up in one asset, and the lack of diversification can create problems if something happens to the asset. And even if you do not have a tenant for the property, you will need to keep paying the mortgage and other maintenance costs out of your own pocket. While the risks can be high, the rewards can be quite high as well. If you've selected a good property and manage it well, you can earn many times your investment if you're willing to hold the asset over time. And if you pay off the mortgage on a property, you can enjoy greater stability and cash flow, which makes rental property an attractive option for older investors. Appropriately named junk bonds or high-yield bonds are rated below investment grade. They come with a greater risk of default but usually pay more than above investment grade bonds, which is how junk bonds attract investors. In 2019, junk bonds produced one of the highest yield returns in a decade. There is such a thing as better quality junk bonds, which may give lower returns but less risk of default. If you don't want to do much investing yourself and prefer to leave it all to an experienced professional, robo-advisor portfolio is a great alternative. With a robo-advisor, you'll simply deposit money into the robo account and it automatically invests it based on your goals, time horizon, and risk tolerance. You'll fill out some questionnaires when you start, so the robo-advisor understands what you need from the service and then it manages the whole process. The robo-advisor will select funds, typically low-cost ETFs, and build you a portfolio. The risks of a robo-advisor depend a lot on your investments. If you buy a lot of stock funds because you have a higher risk tolerance, you can expect more vulnerability than if you buy bonds or hold cash in the savings account. So risk is in what you own. The potential reward on a robo-advisor account also varies based on the investments and can range from very high if you own mostly stock funds to low if you hold safer assets such as cash in a savings account. A robo-advisor will often build a diversified portfolio so that you have a more stable series of annual returns, but that comes at a cost of a somewhat lower overall return. One of the best investments for 2020 is technology in artificial intelligence. Can you say Tesla? Well, their cars are pretty mind-blowing with an unbelievable high market cap. The truth is, we're only scratching the surface when it comes to the possibilities of AI. Market experts predict the main drivers to be in 5G and cloud technologies. With technology continually changing and innovating and a heated race between the US and China in AI, the industry should remain a strong investment option in 2020. Understanding this year's trends should make it easier to decide on the best investments in 2020, whether you are a stock market junkie looking for income-producing investments or interested in expanding into different sectors. Smart investors should perform extensive due diligence with the help of a trusted financial advisor. Invest wisely in a diverse portfolio. Long-term investment is the way to go for a safer and more secure financial future.